In this video, we're going to look at JD.com, and this is an online Chinese retail store. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock, and then look at the financial ratios and compare them with similar companies. I'm going to be looking at JD.com trading on the Hong Kong Stock Exchange. I'm not going to be looking on the stock trading on the American Stock Exchange because their financials are in Hong Kong dollars. It doesn't matter what stock exchange I look at, the price is identical across all the exchanges. So let's get started with the model. This company has a market cap of $730 billion. And that's the value of the company according to the stock market, which is the stock price times the shares outstanding. That equals market cap. And it's trading at $235. Everything's in Hong Kong dollars. Now we need the free cash flow. And the way you value a business is you have to estimate the future free cash flows and then discount that number back to today's value. And that's exactly what I'm doing in the video here. So we're just going to pull their actual free cash flows and put it into the model. We also need the net income, which is the profit and loss for the business, and that's on the income statement. Let's also pull the revenue. That's on the income statement. That's just the sales for the company. And let's take a quick look at the numbers. You can see they have a negative free cash flow and negative net income one year, and also another year where they have positive free cash flow and negative net income. So that makes it more difficult to value a company if the numbers aren't consistent. They also have really good revenue growth year to year, so that's a really good sign that the company's growing. Let's look at the capital structure to get more information, because we need to figure out the discount rate we need to apply to the future cash flows. So they pay $725 million on their debt. And let's go to the balance sheet to see how much debt they have. Go to the liability section. And it's all long-term debt, $10 billion of long-term debt. So they pay 7% interest on their debt. Since interest payments are tax deductible, let's get their effective tax rate. $13 billion of income before tax, and then $1.8 billion of taxes. So the tax rate is 13%, so the cost of debt is 6.3%. To get the cost of equity, we need the beta. That's how much the stock moves relative to the entire market. And we could just easily get that from Yahoo Finance, 0.98. So their stock moves roughly with the market. And let's also get some more information from the balance sheet. We need the current assets. We need this number because when we calculate the current ratio later, that's part of the equation. And current assets are mainly cash, accounts receivables, and inventory. That's $139 million. And let's get their current liabilities. This is how much money the company owes within the next 12 months. And that's $140 million. And the equity, that's the value of the company according to the balance sheet. That's total assets minus total liabilities, and that's $82 billion. Let's get the EBIT, earnings before interest and taxes. On the income statement, that's called operating income. That's $7.3 billion. Let's look at the capital structure of the company. So they have 11% debt in the capital structure, and the cost of debt is 6.3%. They have 89% equity, and the cost of equity is 9.9%. And the weighted average cost of capital is 9.5%. And that's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $317 billion. We divide that by 3.1 billion shares, and we get an intrinsic stock price of $102. They're trading at $235, so they're trading at 130% premium. It's a sell according to the model. Let's see what Simply Wall Street values the company at. They're valuing them at pretty much what they're trading at. They're saying $231, so almost exactly what they're trading at. So like I said, it's really difficult to value companies with volatile numbers like they have. So this is kind of like a best guess estimate. And hopefully as the company matures and the numbers become more stable, we can get a better value. Let's see what the stock has been trading. It looks like it peaked at 265, 270 at one point, but it's come down from the peak. This could be a stock that's going to blow up because online retailing in China, and this is one of the biggest online retailers, kind of like Amazon and eBay. Let's look at the financial ratios to get more information. They have a terrible PE of 60, that's price to stock over earnings per share. They have a good price to sales ratio of 1.3, that's price of stock over sales per share. So the reason they have such a bad PE and a good price to sales ratio is because look at their revenue growing. That's the price to sales ratio, revenue. But the net income is tied to the price to earnings ratio, and they're not doing a good job converting the revenue into net income. And that's the really important part of a business. Bringing in lots of revenue is great, but if it doesn't result in profits, if it's just all going out the door in expenses, it doesn't really add too much value to the firm. Let's look at their price to book ratio. Not a good price to book, that's 8.9. That's price to stock over book value per share. They have an okay current ratio. They could almost cover their current liabilities. They're a little tight there, but they only have 11% debt, so if they need to borrow more, it's not too bad. ROE is not so great. That's net income over equity. Interest coverage ratio is fine. They can cover their interest payments 10 times. And the best way to look at ratios is to compare them to similar companies. I've done videos on Momo and Amazon and eBay. They're all in the same industry as JD. JD has a better than average price to earnings ratio, and they have a bad price to earnings ratio. So their industry is just really lacking in that category. They have a really good price to sales ratio, the best of the four companies. When you compare their revenue to their price of stock, they're providing the best return in that category of the four companies. That's something to really think about. Price to book ratio, they also have the best price to book ratio of the four companies. All the companies are really weak in that category. Current ratio, all the companies are around 1, so they seem to be doing okay. In terms of ROE, they're all doing okay. eBay is doing really well in that category. And debt, none of them are leveraged except for eBay. They're at 73% debt, and JD's only 11%. Amazingly, Momo has no debt at all. I converted Momo's market cap and JD's market cap to US dollars. JD is much bigger than eBay. So it's a big company, JD, and I think it has a great future. And I think it could be one of those stocks that's up there in the thousands one day. So let me know what you think of the video. Thanks for watching.